Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today's episode is going to be slightly different than most of my other ones. Today, I'm going to go through an entire column of requests back on the AI chalkboard back here. If I can get my finger, all right, this one right here. I'm just going to work my way down from the top. I reviewed a few of these quickly, and I thought that it would just be best to do a little bit more quick takes on these rather than deeper analysis, because there's for different reasons for each one. Most of them aren't things that I would consider buying. And so I'm going to give you kind of the quick reasons why. Let's see, there's 1, 2, 3, 4, 5, 6, 7. It looks like there's 7 of them up there. So let's go ahead and get started with that. As always, not individual investing advice, just how I analyze stocks. In case you wonder if I ever buy anything, I have weekly picks over on Patreon for $25 a month, where I try to find the best stock I can each week in the market. And if I don't already own it, I buy it and I share what it is. I have the results of the last quarter here posted on the YouTube channel. I don't show the names of the stocks, but I show how they've done. I also have a free tier over on Patreon, and I also have a 25% off affiliate link for Fast Graphs down in the description, which is what I'm going to use. Fast Graphs is really useful for sifting through stocks quickly, especially to eliminate kind of the ones that don't fit what you're doing or that you're just not interested in, which is 9 out of 10 stocks for me. So it's not unusual and I do have videos on here where I sift through like 30 stocks in 30 minutes and just pull out the 3 or 4 that happen to be worth more research for me. I have certain strategies that I use, have certain reasons why I invest in stocks. And so if a stock doesn't fit that, then unless it's close, like there's just one metric that's missing, then I just move on and try to find something that looks more interesting that fits what I'm trying to do. Okay. So just because I wouldn't buy something or it's not a good fit for me doesn't necessarily mean it won't perform well in the future. But for the type of unconcentrated portfolio approach that I take, I'm not doing deep dives on 1,000 stocks. I'm looking for the ones that have the basic core metrics that I want. And then usually I'm waiting on either fundamentals to improve in some cases or for the price to be right before I buy it. But first, I compile lists of the stocks that I might be interested in buying that are close to having all the metrics met. So let's do this. West Pharmaceutical Services, ticker WST. So I do track this one in my spreadsheet. If we look at, so there are life science tools and services, $20 billion company. I don't remember if they're in the S&P 500 or not. They might be. But if we look at the past 12 years, we have kind of a COVID boom here, a little bit of decline, and now they're only looking at like 5% earnings growth this year. So if we take the fast graph here and we just narrow it down to this time frame, we can get a quick read on the earnings growth at about 14%. I think mine was maybe just slightly lower than that. But a lot of that's going to potentially have to do with this COVID boom here. But even if it was that, so the PE is 40. That's a PEG ratio of nearly 3. I wonder if they used to have the PEG down here. For a while they did. Let's see if it's maybe only on the growth stocks do they do it. I don't see it right now, although it could be right in front of my face sometimes. Okay, so yeah, you think 14% earnings growth. If it was a PEG ratio of 2, that would be like a 28 PE. PEG ratio of 3 would be like 42. And we're almost at that 42. So this would be very expensive, even if they can grow earnings at 15%. But the trend over the last several years has actually been, now part of this is coming off this boom, but really they haven't grown earnings for 4 years. So to pay that much for a company that still is in a downtrend earning-wise, I think is very optimistic. Right now, analysts are looking at 9% and 12%, so they aren't anywhere close to really the 14% in the past, even if they make analyst estimates hit. So To me, this is too expensive. If it got really cheap, then I might consider something like this, even though these types, like pharmaceutical companies, aren't, I guess it's a services company, but it just needs to be cheaper is the bottom line. In my spreadsheet, I don't have a buy price on it because the 3-year revenue trend is negative. It's possible if they pick up some growth in the next year or two, that would change, and then I would add a buy price in at that point. But right now, there's not really a ton of sign. I mean, the market thinks there is, that earnings are going to significantly and revenues are going to significantly start growing. So my take on this one would be kind of monitor it because it does have a good long-term history if you go back here. And so maybe they're just working out this COVID bump, but the market has just got it priced like crazy high. It's kind of ridiculous. So, all right, let's see what my next one is. BGS. B&G Foods. Okay, so we do have data going back to the last Great Recession, which it fell a lot, which shows some cyclicality, although it was a new IPO, it appears. So that could have played into it. But the trend right now is basically since 2017, these guys, for other than 1 year of COVID, have had falling earnings. So this is not the type of business that I want to buy. It's not a short-term downturn cyclical business. This is almost, I mean, likely. It's long. We can see it's long-term pattern, and this is almost likely due to competition and lack of ability to have pricing power. And that long-term trend is not something I want to pick the bottom of. Now, if they do have a hit product and they turn things around, then whoever does buy down here will end up doing fantastically well. Every now and then there's a stock that does that, but I play the odds, and the odds are, I avoided it all this way down for this reason, and I'm not going to change my mind because I know I can't predict when the bottom will be, if there's going to be recovery. I don't do that type of research. So for me, it's not high enough quality. Okay. And I don't do turnarounds. So next we have ASA Gold. Okay, I don't know if I've had too many gold stocks on here. Probably a miner. It says Bermuda. Let's see. Oh, no data, huh? Okay, so I don't know exactly what they do in metals, but from this chart we can see that they're deeply cyclical based on their earnings. Looks like we're now in an upcycle. We don't have data for this year yet on the fast graph. No, where it says it trades in the US. Clearly in an uptrend. This one would just be too hard for me, I think. If I was going to buy gold, I do own one platinum miner. The difficulty is, I mean, the long-term trend is probably in favor of gold in terms of currency debasement. But it has risen a lot. And the problem with the miners is, especially if we have an economic downturn, they'll probably fall a lot before they rise again, like if there's more QE and all that type of stuff. And these stocks can, well, let's just see what they fell. They can fall like 80% easy, like over a long period of time. So 75% decline there over 1, 2, 3, 4, 5 years. So you buy it 2011, 5 years later, you lose 75% of your money. I don't think it's still recovered those highs back then. So these just aren't the type of stocks I want to buy when they're making new highs, usually. Because the downsides can be so horrible. It's hard to know when they happen, when they're going to happen. And so it's just probably too hard for me, I would say, to really have a ton of input. So it would be an avoid for me. Bird Construction. I wonder if this is, let me make sure. That's Canadian. Black Diamond. Okay, we'll go with that one. I'll make sure. Okay, Canadian company. Let's see what they do. Okay, construction engineering. Pretty small company. All right. So they're in a good uptrend here. Maybe that has something to do with AI or data centers or whatever. It looks like it took off around that time, sort of, from here. The problem with this could end up doing really well. I think a person would have to do deeper research and find out exactly. Maybe I can see. Construction services. Okay, industrial, mining, institutional, retailer. So light industrial, build design. I was trying to see if there's anything with like data centers and stuff. So maybe it could just be mining. The Canadians are big on the mining companies. So again, this is a very unpredictable type of cycle. So you have from this peak in 2008 until 2020 for 12 years, you're effectively in a downtrend. Especially we get a recovery here to 2012, maybe you get to even, and then you basically have another 6 years of downturn. These type of downturns are just very hard to predict. An additional problem that sometimes comes up with construction and engineering companies is they can underprice things. This looks like they do smaller projects probably because they had so many different things that they did, and they're only like $1 billion company. They're probably doing a lot of smaller projects is my guess. I don't know that for sure. So probably not as much of this risk, but sometimes these companies can underbid big projects to get them. The backlog comes in, the initial earnings start coming in, they look good, and then they run over budget, and then it costs them a bunch of money, and then they end up losing money sometimes, like a lot of money, and when everything is looking pretty good before that. So that's the danger with some of these. I don't know enough about this one to say whether that's a big danger with them. But who knows? I mean, if it's a Canadian company and things are being repatriated a little bit and industrialized a little bit more, maybe that's good for them. I think this is one that would just require deeper research. But historically, there's not like an easy historical trend, I think, to pick up on, other than since the pandemic. So again, I would be cautious, but I wouldn't like completely necessarily write this one off if there's some catalyst, longer term catalyst that could keep propelling it forward. Okay, Edenred. Okay, I think I remember looking at this one. Okay, so what are these guys? Okay, payment processing. So there's so many payment processing stocks and companies right now. I am kind of being very cautious on my portfolio and just how much weighting I want to have. I know some of them do different types of things, but let's see exactly. I did look at this closer a while back. I just am having a hard time. Okay, digital payment solutions. Benefits. Oh, yeah. Okay, so I remember this one. Let me try to think how it works. It's like a European French thing. So I'm not going to remember this exactly. So you have these meal benefits. So the company can basically provide like a perk. And I think the way it works is you get like a card, and you can go out to actual restaurants in your community and use that company card as a perk. And maybe it's like split 50-50, like the employee pays 50%, the employer pays 50%, and then they get a discount at the restaurants, and then they don't have to pay taxes on that compensation, basically. So it's kind of a win-win-win for everybody. And then these guys get like a cut of running that. And I want to say they're in France and Italy. I did look into this one quite a bit a while back, and I decided to hold off on it. I just wasn't sure how much total addressable market there is, like how transferable and everything this type of program is to other places. It looks like that was probably a good decision. The stock is in a pretty big downtrend. I also want to say they're subject to regulations, if I remember correctly, in Italy. They were changing some of the laws around this. I'm going from memory from several months ago, so you want to look this up. But so yeah, they have that kind of, there's an explanation for kind of why the stock price is going down. I don't know where it would bottom. I wonder what the dividends are. This is one where if it doesn't have much growth, yeah, they're at a 5% yield now, which probably seems appropriate for a moderate growth if you think that they can't like expand globally, you know, like an internet company. And then you have kind of these other kind of human and government issues you have to deal with. The good part is like a 5% yield is not too shabby as long as they can protect that and not have it go down. But if you're a foreign investor, usually if you're investing in French companies, they're going to take like 20% of your dividend taxes. So, and that can be complicated too. So there's lots of different layers that you would have to think of. So I wouldn't say never. If I lived in France, I might consider it, especially if I was more attuned to exactly how the business works and maybe a little bit more of the politics behind it. If you could, and you're just looking for maybe a bond alternative. So if you can get a 5% inflation protected yield potentially, rather than parking money in just euros or something like that, that might be a situation where something like this would be a decent investment. But for me, it's just too many layers upon layers, with probably not enough potential reward for me, for the type of returns that I'm looking for. So almost forgot about that one, but I did remember it. TEP. What is TEP? Pete did a couple of these. I didn't. Oh, Teleperformance. Another French company. Perhaps the same person asked me about this one. Okay, so this is a trend, stock price wise, that is difficult. I wonder what the basic earnings are. About the same. There's not too much difference. So okay. So data processing and outsourced service companies are getting absolutely creamed because of AI. I've bought maybe one company that's roughly in this outsourced services type of business, and it's gotten creamed. And I think these are all pretty much wait and see. And my gut tells me the market might be more right on these than it is wrong. So, you know, if a person wanted to dip their toes into one of them, like I did a tiny little bit and experience the pain firsthand, you know, maybe. But I would say be very cautious. And I would generally say watch the stock price and wait for a real uptrend in some of these. And then they're probably still going to look fairly attractive. This one is down, you know, if that happens, you're not going to be bottom picking. I mean, oh my gosh, it's down 1,000,000% basically. 80% if you include the dividend. So if you end up buying it when it's down 65% and it goes back on its previous uptrend, you'll still do quite well, but you'll miss, you know, if it goes from 80% down to 90% down, well, you lose 50%. you don't lose 10%. That's like a stock that peaked at 100, falls to 20. And you buy it at 20 and it falls to 10, that's 90% down. Well, that's 50% down for you. So I don't know where it's going to bottom, but they can fall a lot more. Well, let's put this. Let's just say you bought this little dip here, like this little bottom. Well, you're still down 32%, and you avoided all that. You didn't buy a way up there. You bought way down here, and you're still down 32%. That's what I'm talking about. So just because it's down 80% doesn't mean you still can't potentially suffer a lot of damage to the downside. So to me, wait for an uptrend for something, any company kind of in this industry at this point. And SoFi. All right, so I already know what my answer to SoFi is going to be. And yikes. Well, I guess that's not too bad, assuming they can keep growing really fast. My issue with SoFi has always been you just don't know what kind of risk they're taking. I mean, they started off doing student loans. They kind of tried to, this is just my interpretation, they tried to if you basically get like graduate students who had a high probability of paying their loans back, but who were stuck in kind of higher interest rate loans. When interest rates were low, SoFi could come in and try to refinance those folks, get them over in the private lending, and still try to keep the credit quality up with people that are likely to pay those loans back. Because a lot of student loan debt is risky. But I do think they had an insight there where they could kind of cherry pick the good borrowers away from the government or the government service companies that are doing the student loans. But the general problem, and then they've gotten into all other sorts of financial businesses since then. I just don't know what kind of risk is there. So when it comes to any kind of lending, I'm pretty much out until they've gone through a down cycle and survived. I don't really count 2022 as a down cycle. So we need to have a recession. Then we'll get to see how their decisions were really, whether how good their decisions really were. And I don't have an opinion one way or the other. They're definitely out working hard, I think. I mean, I see them. I see their analysts. I get mailings from them. They're probably putting their name on stadiums and things like that. So they're out there working it. But I don't think we'll know until there's a recession and borrowers and people in financial services get really stressed. And then we'll see, what the risk was. So we'll see the rewards of the earnings, but we don't always know what risk was being taken to get those until it's too late. And even with companies, so I like to see that a company has at least survived and came out of a recession if they're a financial company. So that's my thoughts on SoFi. Kind of wish them the best, but I trust none of them. So I think that's it. The whole board 7, the whole column, that will be gone when I get to erase one. And hopefully I gave enough information on these to at least, give you something to think about, some perspective that maybe you hadn't thought about before. All right, everybody. Thanks for watching, and I will see you later.